Good evening, everybody. Welcome back. It's been an interesting couple of weeks and obviously an interesting 2 or 3 days going ahead here because we've got some central bank meetings. So whilst we're talking about central banks, it's worth talking about what we call higher for longer. Well, what does that mean? What does it mean? It's used to suggest that interest rates, mainly due to inflation, are probably going to stay higher, possibly even move higher, but at least stay elevated for longer than was originally thought. And with inflation being rather sticky, if you like, then central banks have got a problem. We've seen some of the RBA, there's other central banks like the RBA and the Bank of Canada surprisingly hiking again, having paused originally, but inflation refused to go away. And so last week, they've had to go back to hiking. The Fed is discussing just a skip rather than a pause. So missing one meeting and then hiking again in July. And that's kind of what we have priced in for tonight. So that's very interesting as well. So this has implications for all financial markets, but especially commodities, as it impacts just about all their key drivers. So what are those key drivers? Well, first of all, obviously with commodities, we have the inevitable and individual supply and demand dynamics. So, obviously at the moment when demand is sort of drifting away, global growth is falling, demand falls, China's not very strong, supply overwhelms demand. And so that's quite an easy thing to understand. But also we have to remember that commodities are priced in dollars, to a large extent, and therefore the price of the dollar matters. So often we see when the dollar rises, we see, for instance, precious metals come under pressure, sometimes copper. It depends what's going on the geopolitical front or the supply and demand front. But in periods of quietness, the dollar actually does impact commodities quite a lot. So with that, obviously, interest rate moves from the central banks matter a lot because they impact the dollar and currencies. So that obviously is something we need to bear in mind. And with the Fed tonight, the ECB tomorrow, and the Bank of Japan on Friday, then obviously, commodities are a little bit nervous. I think we've seen a little bit of book squaring into these meetings as people sort of get a little bit nervous of what may happen, but also general risk sentiment. We see an awful lot of, when stock markets are rallying and sentiment is good, the dollar's a little lower, we often see commodities do well. So there is a sentiment driver there as well. And I think that's quite interesting. Again, whilst sentiment has been going up and stock markets have rallied, it's been very disappointing to see the likes of copper and oil still fall within that environment, which shows you that the demand story was the bigger story going through the last couple of weeks rather than the risk appetite and everybody feeling good about equities. So really interesting what's going on with commodities at the moment. And I think that's something quite interesting. But, to be honest, the central banks have something of a dilemma ahead of them. And it's facing all Western central banks, really. I mean, despite all the hikes to date, inflation levels are still well above central bank targets of 2%, particularly the core. This is inflation extrapolating food and energy, which is extremely volatile. So the central banks prefer to ignore that. But we have seen some price pressures ease in the US, as you can see on the bottom left chart here. They are drifting off. This is headline, but core still staying nastily high. So we've had a big fall in oil, gasoline, all sorts of byproducts of that. But still we see this elevated core inflation with higher rents. Eurozone inflation falls to its lowest since Ukraine invasion. But again, look at the sticky core inflation. It's not going away. And this is where the focus is with central banks. Now, the interesting thing about this is that the dilemma the central banks have is that consumers are still spending on services. So what is that? That is enjoying yourself, basically. So anything that is to do with travel, holidays, eating out, bars, restaurants, the rest of it. It's all about that. And this is the customer-facing, consumer-facing services products that we have. And this is keeping inflation elevated. In countries most of the way around the world, it is this and this only that is holding up the economies. Now, it's interesting that the US is moving dangerously close to the 50 level, which discerns the difference between contraction and expansion. And so we're going to keep an eye on services data a lot, but that is keeping the markets higher. And unfortunately, we've seen inflation hold pretty high. I mean, in the UK, as you can see on the chart here on the right, inflation gauge there, 31-year highs. Core inflation is just still rising. Wages are still rising. Unemployment is still low. The jobs market is tight. The central bank is going to have to do more. What does that mean for commodities going forwards? And also, this reduction in commodity prices is seeing PPI, which is an inflation dynamic. This is the finished goods products or factory gate products are beginning to fall. So hopefully the big exporters will start exporting deflation rather than inflation going forwards. But it's difficult because demand for these commodities is still falling, which shows a demand growth problem, and that is suggesting that growth is very weak in some of these major economies still. And at the same time, we have higher interest rates, which are designed to slow growth further, leaving commodities potentially even more exposed going forwards. So the central banks are trying to push down growth. They've got very high inflation. But what happens if growth starts to move down very quickly? We could move into recessions. Are we being hiked into recessions? I think that's very clever. Looking forward, interest rate moves work with a lagged impact. And this is one of the problems that the central banks really do face as a problem. This lagged impact with sort of kind of lagging data as well makes it very difficult to understand exactly what impact the interest rate hikes that we've seen already are having on growth and the market and the economy in general. So the global growth structure looks rather weak at the moment, but these rate hikes are looking like they're going to continue, and this could be a problem later in the year. Now, I think we need to focus quite a lot on China for the recovery side of things, and it's looking like they're going to be cutting rates. There's a policy decision tomorrow. It looks like they want to boost some of the flagging growth. Some people are expecting a big stimulus as well. I'm not sure we're going to get that. In the past, they've been very large indeed. I think that's harder to do for them now. So this is all going to sort of come into this. If they're not prepared to do enough, commodities could then again find the sort of bottom drop out of them. So China's a big player in all of this right now going forward. So keep an eye on that. But, this COVID reopening momentum, this could offset some of the potentially negativity from the Fed, ECB and BOE hikes. So I think it's going to be really interesting that the higher hikes, if China doesn't come into the game soon, then I think there's going to be a lot of pressure on growth. There's going to be a lot of pressure on commodities, and the dollar, is mixed at the moment. But hopefully, one of the things that may save commodities going too much lower is if the dollar starts to fall precipitously. But at the moment, that's not looking like it's happening at the moment. If we look at energy commodities, pretty close to this year's lows. Oil has seen successive OPEC plus cuts. They haven't done anything, but they're cutting because there is a slowdown in global demand for oil, and therefore they need to reduce the price to the production to hold prices where they can. It's not really working. So, there is talk that the US is going to start replenishing some of its oil reserves. Their security that they have on this. But as you can see on oil here, if we start taking out these $63 capitulation lows, it's going to look very ugly indeed. At the moment, they're holding pretty well, but it looks like we're in a bit of a downtrend. Very interesting markets, the oil market, with the demand dynamics out there. Natural gas is another one. It's been boosted by expectations of lower production later in the year for natural gas. Some of the drilling has been halted because the price is so low. It's not economically viable to get the stuff out of the ground as it was. So, but, we're in the middle of the range here. Are we going to break higher? Are we going to break lower? The dollar may have some play in that. I think, if we get another mild winter coming up, then gas prices could fall quite a bit lower as well. So there's a lot going on. The dollar impact, everything impacting that. But this moves on to precious metals as well. Commodities are still moving. We've seen a bit of a bounce in copper. Funds literally for a long time have been betting against copper prices, and they've been very correct. That we've seen quite a big down move in copper recently. This again based on the lack of global growth and the recovery in China. But can this move continue further if global demand falls further? So, we're holding up, we've bounced at the moment, but look at this chart here. Are we going to start pressing the downside again, or are we going to take out these recent highs that we saw up around 395.82 made on May the 7th? Really interesting markets at the moment. There's a lot going on. And I think, one of the questions I get asked a lot is, what's going on with gold? Well, again, higher interest rates and improved risk sentiment has hurt long positioning, really, because gold rallied because we saw that stress in the markets created by the regional banking crisis. That seems to be moved to the back burner. It's not making the headlines at the moment. Risk appetite is improved. So market have calmed down. And guess what? Those who bought gold on the stress in the markets are having to capitulate. So here we are on gold on the bottom right here, showing you, if we take out those lows at 1932 made on May the 28th, that could have a bit of a nasty impact for the bulls. But could we break this downtrend that we're seeing develop on the upside as well? Maybe if the Fed do nothing tonight and we see the dollar further down, we might see gold pop higher. There really is a lot in play at the moment for commodities. And I think it's really quite a fascinating market to look at. Even if you don't trade them a great deal, have a look at these. There's a lot going on that influences them. And I think it's really fascinating to watch.